Imagine it's the year 2063, and suddenly every single piece of digital security protecting your bank account, your medical records, the national defense grid, it all just becomes entirely obsolete overnight.
Yeah, just wiped out.
Right. It's a terrifying thought. But welcome to the deep dive, everyone. We are thrilled to have you with us today. And, right now, artificial intelligence is absolutely dominating the headlines. I mean, it's everywhere.
Oh, totally. You can't escape it.
You really can't. But today, we aren't actually talking about the current AI boom. We're looking past it. We're looking at the hum of the next massive leap in computing power that is just quietly building in the background. We are talking about quantum computing.
And, it is a fundamental paradigm shift. Like, we aren't just looking at processors that run a bit faster.
Right. It's not just a better microchip.
Exactly. We are looking at a technology that alters what is computationally possible. It's poised to completely rewrite healthcare, cryptography, logistics, and, well, global finance from the ground up.
But, okay, here's the question for you, the listener. How do you actually position a portfolio for a paradigm shift when the underlying tech is, still fighting its way out of the laboratory?
Yeah, that's the tricky part.
It is. And that is our mission today. We are going to identify the 5 best exchange-traded funds, the ETFs that actually give you exposure to this quantum computing frontier.
Because picking single stocks right now is, it's tough.
It's wildly risky. So we'll break down their specific holdings, analyze their expense ratios, their performance, and weigh the biggest upside against the safest harbors, all while looking at the projected 10-year growth of this whole industry. So, okay, let's unpack this.
Yeah, to really grasp the philosophy behind these different funds, you first have to understand the sheer scale of the financial projections and, crucially, the timeline we are working with here. So let's start with the bull case. The projections for quantum commercialization are just staggering. McKinsey predicts that quantum revenue will scale from roughly $4 billion in 2024 to an astonishing $72 billion by 2035.
Wait, 72 billion? That is a violent upward trajectory for just a single decade.
It is. It's massive. And Intellectia AI, they project a 34.8% compound annual growth rate, mapping out a $12 billion market by 2032.
Wow.
Yeah. And the private markets, they're reflecting this optimism really aggressively. Venture capital funding in the quantum space hit $1.9 billion in 2024.
Which is huge. Right?
Oh, it doubled the total capital deployed the previous year. Yeah. So the institutional money is flowing because the mechanical advantage of this technology is absolute.
Okay, let's visualize that mechanical advantage for a second, because I think we need to move past the sort of dry textbook definition of classical bits.
Yeah, please. The textbook definitions get a bit dense.
Right. So think about a complex optimization problem as a massive, intricate maze. A classical computer, even like a supercomputer, is essentially just a very fast mouse. It has to run down every single path, hit a dead end, turn around, and try the next path sequentially until it finds the exit. But a quantum computer, because it uses qubits in a state of superposition, it doesn't run the maze sequentially.
No, it doesn't run it at all.
Exactly. It floods the entire maze with water. It explores every single pathway simultaneously through wave interference, finding the optimal route basically instantly.
That is like the perfect way to frame it. The computational bottleneck that defines classical architecture just completely washes away.
Right.
But, we have to counter that mechanical brilliance with the bear case. We really have to look at the physical realities of building these actual machines.
Because flooding the maze is a lot harder in practice than it is in theory.
Precisely. Let's look at Cathie Wood's ARK Invest, for example. They are an institution entirely built around backing disruptive, futuristic tech.
Yeah, they love this stuff.
They do. Yet they recently issued a pretty stark warning to investors. They stated that we might need to wait 20 to 40 years for quantum to cause true mainstream disruption.
20 to 40 years, that's a lifetime in tech.
It is. And they pointed to the hardware bottleneck. Despite billions in R&D, Google has only managed to double the number of qubits in its system once in 4 years.
Okay, I want to pause on that, because that lack of scaling is the elephant in the room. Why is doubling qubits so difficult for a company with, Google's infinite resources?
It really comes down to error correction and something called crosstalk. Qubits are incredibly fragile.
Okay.
The more you pack next to each other, the more their quantum states actually interfere with one another.
Yeah.
It isn't like traditional silicon where you can just, shrink the transistors and pack more onto a chip.
Right. It's not Moore's law.
Exactly. It is an exponential engineering nightmare to maintain stability. And that is why ARC estimates that under the current status quo, quantum computers won't be stable enough for cryptographic decryption until 2063. Yeah. And even in their most aggressive, optimistic scenario, they project 2044.
Wow. So we have an industry projected to hit $72 in a decade, but the actual milestone of breaking cryptography might be a 20 to 40-year wait.
That's the reality check.
And that massive uncertainty really highlights why taking a concentrated position in a single individual quantum stock right now is incredibly dangerous. I mean,
Yeah.
you're betting against the clock and the huge cash burn of early stage
Oh,
startups.
absolutely.
And that leads us perfectly into why we are analyzing ETFs today. It's to capture that massive upside while mitigating that concentrated risk. So let's look at the actual funds. Where do we start?
Well, if avoiding single stock risk is the main goal, the most logical starting point for an investor is the biggest, most established ETF on the market. And then we can pressure test it against its newest, most direct competitor.
Makes sense.
So ETF number one is the Defiance Quantum ETF. The ticker is QTUM. QTUM. This is really the undisputed heavyweight in the space right now.
And they launched back in 2018, right? Which gives them a pretty significant track record in what is a very young sector.
They do, and they have the institutional gravity to prove it. I mean, QTUM has a massive $3 billion plus in assets under management.
$3 billion. That's huge.
Yeah, and their expense ratio sits at a reasonable 0.40%. As for performance, they've posted over a 370% return since their inception, and they were up 36% in 2025 alone.
Okay, so I am looking at their methodology right now, and they track the Blue Star Index. They hold 84 different companies, and their primary inclusion rule is that a company must derive at least 50% of its revenue or operating activity from quantum computing or machine learning.
Mm.
But when you dig into the actual holdings, it raises some questions for me.
Oh, I bet.
Yeah. Like their top holdings feature companies like Micron at 1.86%, Teradyne and MKS, but then they also allocate 13% of the fund to industrials, and they hold massive defense contractors like Lockheed Martin and Northrop Grumman. If the rule is 50% revenue from quantum or machine learning, how does an aerospace defense contractor fit the bill? Are they secretly quantum pioneers or what?
What's fascinating here is how broadly Defiance actually defines the quantum ecosystem. QTUM isn't just looking at the companies building the physical quantum processors. They're looking at the applied threat detection side of the technology.
Ah, okay.
Yeah, those aerospace and defense giants, they are pouring massive capital into next-generation cybersecurity quantum sensors and defense tech that relies heavily on advanced machine learning. So QTUM casts a very wide net to capture all the ripple effects of the technology.
Right, but casting that wide of a net kind of dilutes your exposure to the actual quantum breakthroughs, doesn't it? Like
Yeah.
if you want to strip away the defense contractors and the industrials and bet purely on the tech giants driving the core Qubit research, you have to look at how the newest challenger approaches the space.
Exactly.
And that brings us to ETF number 2, which is the Wisdom Tree Quantum Computing Fund, ticker WQTM.
Yeah, and this is the pure contrast to QTUM. WQTM launched very recently, carrying a tiny AUM of around $16 to $25 million as of early 2026.
Very small compared to $3 billion.
Tiny. The expense ratio is slightly higher, too, at 0.45%. But their construction methodology is entirely different. They're highly focused, holding only 37 stocks, utilizing a proprietary weighting system.
And that proprietary weighting aggressively targets the foundational hardware players that QTUM kind of ignores, right?
Crucially, yes. WQTM holds heavyweights like Alphabet and NVIDIA right in its top 10, whereas QTUM pushes those massive names much further down their allocation list and entirely excludes certain hardware players.
Like Micron.
Exactly. Take Micron, for instance. It's QTUM's top holding, but WQTM doesn't hold Micron at all. WQTM is really isolating the big tech names actively developing the core quantum processors and the immediate algorithmic frameworks.
So it's a stark philosophical divide. You've got QTUM giving you this holistic, somewhat indirect ecosystem view that includes defense and industrial applications, while WQTM is making a highly concentrated bet on the major tech players driving the baseline research.
Exactly right.
But, if we are talking about the hardware itself, we really need to address the physical environment these machines require, because a quantum computer doesn't just sit in a standard server rack in a closet somewhere.
Oh, far from it. As we mentioned with the hardware bottlenecks earlier, maintaining a quantum state requires near absolute zero temperatures. I mean, any environmental interference, heat, vibration, basically destroys the computation.
And here's where it gets really interesting. You can't just plug a quantum processor into the wall. You need extreme physical infrastructure to keep that system stable.
Right.
Which is why ETF number 3 ignores the processors entirely and focuses on the structural reality of the hardware, like selling shovels during a gold rush.
Exactly.
This is the Global X AI Semiconductor and Quantum ETF, ticker CHPX.
Yeah, CHPX approaches the sector strictly through the lens of what they call compute system enablers.
Compute system enablers.
Right. We are talking about the companies engineering the high-capacity HVAC systems, the extreme dilution refrigerators, and the highly specialized data center infrastructure required to keep these fragile quantum models from experiencing decoherence.
I'm looking at their stats right now. They have a 0.50% expense ratio and roughly $20 million in AUM, having launched in September 2025.
Mhm.
But what really stands out to me is their weighting methodology. It uses a modified capitalization weighting, but it strictly caps any single security at 10%, and it requires a minimum $1 billion market cap.
Right.
That tells me they are highly aware of how fragile this specific hardware supply chain is, and they're absolutely terrified of being overly exposed to a single cooling or infrastructure vendor.
Oh, they are actively managing for fragility, particularly on a global scale. In fact, the prospectus for CHPX explicitly isolates the fund from geopolitical fallout. They specifically exclude companies domiciled in China, India, Russia, and several other nations.
Okay, that's a critical structural detail. They aren't just looking at the technology, they are treating the physical supply chain as a primary market risk.
Exactly.
And um, just to be clear and completely impartial here for you listening, we aren't endorsing any political stance. We are just reporting what's in their financial disclosures.
Right, of course.
The fund managers explicitly cite the ongoing United States trade war with China, along with tariff threats targeting Mexico and Canada, as severe vulnerabilities. So by structuring the ETF this way, they are trying to insulate the portfolio from the potential for massive component cost spikes and international supply chain paralysis.
It is entirely a defensive infrastructure posture. Now, let's contrast that sort of U.S. and allied-centric supply chain play with an ETF that takes a deliberately international, legacy-heavy approach.
Okay, bringing us to ETF number 4.
Yes. This is the iShares Quantum Computing UCITS ETF, ticker QNP QANT.
Now, the UCITS designation means this fund operates under European regulatory frameworks, right? Domiciled in Ireland.
Correct.
It carries a 0.50% expense ratio with $17.13 million in AUM. But the defining characteristic of QANT is its extreme top-heavy concentration across only 30 holdings.
Oh, it's incredibly concentrated at the top. Just look at how they allocate their top 5 positions. Intel anchors the fund at over 10%.
Wow.
Yeah. Alphabet follows at 8.68%, Nokia at 7.4%, Microsoft at 7.06%, and IBM at 6.72%. Those 5 legacy technology companies constitute roughly 40% of the entire portfolio.
Almost half the fund in 5 companies.
Right. And it is only after that massive legacy buffer that the fund trickles down into the smaller, highly volatile, pure-play quantum startups like IonQ, D-Wave, and Rigetti.
So it operates almost like a ballast on a ship. You have Nokia in Finland sitting alongside the American hyperscalers, heavily weighting the top of the fund to provide stability. And then you have this highly speculative sprinkle of pure quantum startups at the bottom.
That's a great way to put it.
Okay, so we've analyzed the massive index approach with QTUM, the concentrated big tech bet with WQTM, the physical infrastructure play with CHPX, and this global legacy mix with QANT. But all 4 of those are passive strategies. If ARK Invest is warning us about a 20 to 40-year timeline, how do you navigate that without active human oversight, like someone constantly monitoring it?
Well, you look at ETF number 5, which is actually managed by the very firm that issued that timeline warning, ARK Invest.
Oh, interesting.
Yeah. This is the ARK Autonomous Technology and Robotics ETF, ticker RRKQ.
And because it is actively managed, meaning human analysts are constantly adjusting the allocations based on real-time research, rather than just tracking a rigid index, you are paying a premium for that.
You are.
It has a higher expense ratio of 0.75%. But it is a massive fund with $1.82 billion in AUM. And notably, it posted a stellar 46% return year-to-date in 2025.
It's done incredibly well, but it is crucial to note that ARKQ is not a pure-play quantum fund. ARK allocates roughly 15 to 20% of this ETF to quantum applications through companies like Tesla and UiPath.
Okay, let's drill into that for a second. Because on the surface, including an automaker in a quantum computing discussion seems completely disconnected. Like, how exactly does Tesla utilize quantum computing?
It comes down to material science.
Mm,
Simulating new battery cathode materials at the molecular level is something classical supercomputers just struggle with.
because of the complexity.
Right, due to the sheer volume of electron interactions.
Mm.
Tesla utilizes quantum algorithms to simulate battery chemistry and optimize global supply chain routing. Yeah. So ARC's strategy here is active hedging. They firmly believe quantum will dictate the future. But because the hardware maturity is decades away, they are blending it with robotics and AI technologies that are actively commercializing and generating revenue right now.
So they aren't just sitting around waiting for 2040.
Exactly.
So what does this all mean for the portfolio? We have laid out the 5 ETFs and their underlying mechanics. If you are weighing these options as an investor, how do we evaluate the biggest potential upside versus the safest long-term harbor?
Well, for the absolute biggest upside, you're looking at QTUM and WQTM.
Okay.
By holding the early-stage pure-play quantum companies,
Mm.
the IonQs and the Rigettis, you are capturing the raw beta of the sector. These are companies that are burning through massive amounts of cash, which makes them highly volatile.
Right.
But they are also the ones making the fundamental scientific leaps.
Hmm.
If a commercialization breakthrough happens in 5 years, instead of ARC's projected 20, these funds hold the explosive skyrocketing potential.
But with that pure play upside comes the very real risk of those startups failing to secure their next round of funding and just going bankrupt.
That's the gamble.
Right. So what defines the safest option then?
The safest options are QANT or RRKQ. By heavily weighting established, cash-rich tech giants like Intel, Microsoft, Alphabet, and Tesla, they provide a vital growth buffer.
Because they have other revenue streams.
Precisely. Even if a fault-tolerant universal quantum computer takes 30 years to engineer, these legacy companies are not going bankrupt while they wait. They will continue to generate hundreds of billions in revenue from classical cloud computing, traditional AI infrastructure, and robotics.
Okay, I have to challenge the premise of that safety, though. Consider the paradox of that strategy. If the safest quantum ETFs are just heavily weighted with Microsoft, Google, and Intel, are you actually gaining meaningful exposure to a quantum ETF? Or did you just accidentally purchase a standard big tech index fund that slapped a futuristic high-fee label on the prospectus?
That is such a good point. It is the central dilemma of thematic investing. You are actively trading pure exposure for financial stability.
Yeah.
You sacrifice the lottery ticket upside of a pure startup to ensure your capital isn't completely wiped out if the entire technology encounters a 10-year research winter. You are essentially paying for survival.
It is a critical trade-off to consider. So let's summarize the landscape we've mapped out today for you. We started with the promise of a $72 billion quantum market by 2035, weighed heavily against the physical engineering bottlenecks that could delay cryptographic decryption until the 2060s. To navigate that timeline, we looked at 5 distinct paths: the broad threat detection ecosystem of QTUM, the concentrated big tech qubit research of WQTM, the critical infrastructure and supply chain isolation of CHPX, the globally ballasted legacy mix of QNT, and finally, the actively managed robotics blended hedge of IRKQ.
And if we connect this to the bigger picture, the most pragmatic takeaway isn't trying to perfectly time which of these specific strategies will dominate the next quarter.
Yeah, you can't time this.
You really can't. Given that we are staring down a highly volatile, multi-decade technological revolution, the most effective approach is a disciplined dollar-cost averaging strategy.
ACA, yeah.
Yeah, by systematically allocating capital into one or two of these ETFs over time, you smooth out the volatility, you capture the inevitable upside of the quantum revolution without exposing your entire portfolio to the failure of a single startup that might, run out of runway in 5 years.
That disciplined approach really is the only way to survive a paradigm shift like this. Now, before we sign off, I want to leave you with one final thought to mull over. We opened the show by discussing ARC's projection that quantum computers won't be powerful enough to crack current cryptography until roughly 2044 or 2063.
Yeah, that looming threat.
Right. But think about the sheer panic when that day finally arrives. When a quantum system actually achieves the stability to break classical encryption, every single piece of digital security on Earth becomes obsolete overnight.
Total chaos.
Exactly. With that reality looming, maybe the smartest hidden gems inside these quantum ETFs aren't the tech companies racing to build the processors at all.
Oh, that's an interesting thought.
Maybe the true long-term winners will be the defense and cybersecurity companies like Lockheed Martin, hiding right there in the broad net of the QTUM fund, who will be handed basically unlimited government contracts to patch and protect a suddenly broken digital world.
That is a brilliant angle to consider. The defense against the disruption might prove far more lucrative than the disruption itself.
Absolutely. Just something to keep in mind as you evaluate your own exposure to this space. Well, thank you for joining us for this deep dive into the quantum frontier. We really hope it provided some clarity on what is a highly complex market. Keep analyzing, stay curious, and we will see you in the next one.